Welcome back to Dollar Chronicles. Okay, so today we're decoding a massive, high-stakes financial maneuver that's happening totally under the radar of global markets. We've got a seriously compelling explainer lined up for you, tracking the hidden strategies of the world's biggest money managers. So make sure you hit subscribe, and let's just get right into it.
So, what exactly happens when one of the most powerful financial forces on the planet suddenly hits a brick wall? I'm talking about $936 billion. That is the estimated war chest of Singapore's sovereign wealth fund, GIC. Look, they're a quiet, absolute juggernaut in the global financial system. But right now, behind closed doors, the executives managing nearly $1 trillion of a nation's wealth are facing a really serious problem, and it's literally forcing them to completely rethink their entire playbook. Okay, let's dive into this because the immediate urgency here is staggering. GIC just released their performance data, and they posted an annualized 20-year real rate of return of just 3.4% for the period ending March 2026. That's a drop from 3.8% the year before. But more importantly, this is their weakest long-run performance since 2020. I mean, for a fund designed to aggressively compound wealth and beat global inflation over decades, this downward slide is a blaring siren. The market is shifting hard, and what used to work for them is suddenly losing its edge. But you know, this wasn't an accident. CEO Lim Chao Kiat actually went on the record with a very specific explanation. He said, "We wanted to focus on diversification, and we took less risk." So they purposely cooked their foot off the gas to shield themselves from volatility. But come on, you don't manage $1 trillion by just playing defense forever, right? The defense was just phase one. And as we're about to see, they are gearing up to execute a massive high-stakes pivot to turn this yield around. The sleeping giant is waking up. And here is the bombshell. To supercharge their returns and navigate a ridiculously uncertain global market, GIC is planning to deploy an additional $30 billion into hedge funds. And they're going to do it fast, rolling this capital out over the next 3 years. Let's be clear, this is not just some minor portfolio rebalancing. $30 billion is the GDP of an entire country, and GIC is injecting it straight into the most aggressive, complex investment vehicles on Wall Street. Crucially, Group Chief Investment Officer Brian Yeo is surgically targeting 3 very specific types of funds: global macro, quantitative, and multi-strategy. Why those 3? Well, because the modern market is moving faster than ever. These specific funds span multiple asset classes, and they rely on heavy algorithms and vast macroeconomic trends. Basically, they have the unique ability to dynamically manage risk and rapidly pivot the second that market conditions change. Right now, for GIC, it is all about speed and agility. Now, this massive $30 billion move isn't just some sudden panic response. Actually, over the past decade, GIC has tripled its hedge fund investments globally. They've been quietly laying the groundwork for years, totally anticipating a future filled with extreme economic uncertainties. They knew the traditional stock and bond portfolio just wasn't going to be enough to survive the coming decades. So, they built a massive hedge fund engine. Section 1. Navigating the AI hype. So GIC's broad strategy is basically to own the whole AI value chain, right? Investing in infrastructure, product builders, and the legacy companies that are using AI to upgrade their operations. However, they are flagging some severe concentration risks. They actually believe the blind rush into chip manufacturers, data centers, and massive AI models has made it brutally difficult to pick actual long-term winners. The competition is just way too hot, and the capital spending is honestly too heavy. This crucial point is captured perfectly by CIO Brian Yeo, who warns, very likely in the entire AI ecosystem, there will be some pockets of hype and overvaluation. Let that sink in. They are terrified of concentration risk. While the rest of the world is throwing blind money at literally anything with the letters A and I in the prospectus, GIC is holding back. They're deploying that hedge fund capital to navigate around the massive inflated pockets of hype they see forming across the tech sector. But here is where the story takes a super fascinating turn. Compare GIC's cautious, hedge fund-heavy pivot to their sister fund, Temasek. Temasek is another Singaporean state investment giant, managing over $518 billion. But instead of playing it safe with AI, Temasek is hitting the gas. They are aggressively pushing to raise their AI exposure from 6% to a whopping 15% of their entire portfolio by 2031. It's a stunning contrast. You have 2 titans of sovereign wealth facing the exact same market, placing 2 entirely different bets on the future of human technology. I want to pause right here and ask you, who do you think is right? I mean, is GIC making the smart play by deploying $30 billion into hedge funds to avoid AI overvaluation? Or is the AI market a massive bubble waiting to burst and Temasek is flying way too close to the sun? Drop your thoughts in the comments below right now. I read every single one, and I really want to know where you think this market is actually heading.
All right, to execute this precise navigation around market bubbles, GIC actually had to rewrite their own internal rulebook. On April 1st, they activated a completely refreshed investment framework, and this new structure is designed for one specific purpose: flexibility. Look, in a world where markets are becoming incredibly difficult to predict, being locked into rigid asset allocations is basically a death sentence for returns. This new framework allows them to shift massive amounts of capital on a dime.
Under this new risk strategy, equities, which represent their growth engine, have been bumped up to 56% of the portfolio. Meanwhile, fixed income, their safety net, fell to 22%. The remaining 22% is locked into real assets, providing some really vital inflation resilience. And those new hedge fund allocations we talked about, they're distributed smoothly across all these groups depending on their specific mandates. Honestly, it's a beautifully engineered, shock-absorbing machine.
Now, for those of you watching right here in the US, this next detail is absolutely crucial. Despite being a Singaporean sovereign wealth fund, a half a world away, a massive 53% of their exposure remains right here in the Americas. Think about that. When GIC shifts $30 billion into hedge funds, when they worry about AI overvaluation, they are talking directly about American markets, American tech companies, and American jobs. Their bets literally move our markets.
So what's the ultimate takeaway from this explainer? Well, despite the headlines focusing on that 3.4% real return dip, you really have to look at the raw cash. Before accounting for global inflation, GIC's annualized nominal return in US dollars sits at a very solid 5.6%. To put that into perspective, over the last 20 years, they have nearly doubled the real purchasing power of the reserves they manage, and in nominal terms, they've tripled it. So make no mistake, their wealth preservation engine is still compounding heavily.
Understanding how trillion-dollar funds move their money gives you the ultimate edge in understanding where the global economy is heading. If you found this breakdown valuable, go ahead and smash that like button right now and make sure you subscribe to Dollar Chronicles. We're constantly pulling back the curtain on the most complex financial moves happening around the globe, distilling them into clear, actionable visual explainers just like this one. GIC's $30 billion hedge fund gamble proves that the world's smartest money is quietly preparing for major market turbulence, actively dodging the AI hype that retail investors are just rushing into. So the final question is, if a trillion-dollar wealth fund is pulling back to protect their assets, is your portfolio prepared for what comes next? Keep diving down the rabbit hole with our other explainers on screen right now. If you thought this story was incredible, wait until you see the next one. Click the next explainer on your screen now, and I'll see you over there.